Morning.
Morning, Dimitri. How are you?
Good. How are you?
Good.
Okay. So you are guys gonna let me run the presentation from here, right? Give me control of it.
Yes.
See it?
Yep. And Duran will be producing the session, so he just joined so he can walk you through.
Okay. So can everybody hear us?
Yes.
Yes. Yep.
Okay. There's four people, I guess.
Yeah, so there's the three of us, and then we have one attendee who joined now. All of the attendees will automatically have their microphones off and their cameras off, so they won't be able to speak or be seen. The only people who will be able to turn their cameras off or on, I should say, and their microphones on, which I'm realizing my camera's
Okay.
not on, will be us as the organizers or presenters, and then Jeff, who's going to be joining as the MC in just a moment.
Should we test to see, giving me control of the presentation, make sure that works, or you guys are
Yes,
comfortable?
so I will pull that up now just to make sure that you're all good there. Just a sec.
I also think Tori just sent over the final
Yeah, she just
PowerPoint as
did.
well,
I
if
see
that's the
it.
one you
So
should go
that
over.
should be what we have, right? You sent her the final PowerPoint that we set up, Shan.
Yes.
Okay. All right, I will get that pulled up here. Okay, and then Jeff is on. Good morning, Jeff. How are you?
Good morning. I'm great. How are you?
Good, good. I hear that you are going to be the MC for us today.
That's what I heard too.
Do you have that script that Tori created? Did you send that your way?
Yes, I do.
All right, awesome. How are you feeling about like the two housekeeping slides before Dimitri gets started? Do you need anything from our end on that part? Of course, we'll be on the back end or on the background, checking the chat, making sure everyone's good from a tech perspective and conferences IO. But is there anything you need from us?
I don't think so.
So,
Pick 'em, ready to
Durant,
go.
can I get access to it to see if I can make sure that I can go back and forth on this?
Yes. So if you
Where it
at the
says
top
take
of the Teams
control?
window, yeah, hit take control, and then you'll be able to advance the slide. So Jeff is going to go over with everyone.
So now
He's
let me ask you this. When I click this, I see a whole bunch of slides at the bottom as well. What do the audience see? Just one slide?
Yeah, we just see the welcome slide. That's the presenter view. If you want to turn that off, it'll also make the slide a little bit bigger for you. You can hit those three dots that are
Oh, no,
near.
no, this is fine. This is fine.
Okay,
No problem.
perfect. Perfect. So Jeff will go over these first two slides, explaining like the most common audio issues. Um, we'll also be able to assist people in the chat if they're having any issues seeing or hearing you all. And then the following slide will be the instructions on checking in for CPE. We'll send some information in the chat as well, just to catch anyone who may not hear Jeff when he's going through that or joins a little bit later on. We'll also give a QR code in the chat for people to scan if they have any issues checking in the usual way that we do. And then it's all you, Dimitri.
All right, sounds good.
Awesome. Well, we have some people joining us now. The recording started, so we can give it a few minutes for
Yeah.
the rest of the crew to join, and then we can get started at the top of the hour.
Excellent.
Awesome. Thank you both.
Thank you.
Thank you, Duran.
Ladies and gentlemen, good morning. We're about 3 minutes away from our kickoff time. Hopefully you can hear me. We'll be back in about 3 minutes or so to get started. Good morning, everyone. Thanks for coming into the session. We have about 2 minutes to our kickoff time. So we'll be back with you in about 2 minutes. Ladies and gentlemen, thanks for coming in. We're about 1 minute or so away from our start time, so we'll be back with you in just about a minute to kick things off. Thanks. It's 9 o'clock. So ladies and gentlemen, thank you very much. Good morning. Welcome. And thank you for joining us for Bonadio's annual Financial Institutions webinar series. This is our first session, Economic Update, Surging Debt and Falling Inflation. My name is Jeff Paley. I'm a partner here at the Bonadio Group. Very pleased that you were able to join us this morning. Before we get into the content, I know we're all eager to get into the content, but before we get into the content, just a couple administrative things. You can see on the slide, hopefully you can see on the slide on the screen related to the content and the audio and adjusting your audio. Hopefully you can see and hear what's going on right now. If you can't, please use the chat feature in the software. We have folks on the call right now to help with technology type questions if you're having trouble being connected or hearing or seeing things. But hopefully you're hearing and seeing things right now. On the next slide, which I don't know if I can advance. If we could flip to the next slide, related to the CPE, we know a lot of you are here to get the continuing professional education. And on the next slide, which I don't know, Dimitri, can you switch to the next slide?
I have. I think the first slide that I see right now is welcome. Now I'm putting it steps for CPE. Don't you see that?
Oh, you are? Okay.
Yeah. Right now it says steps for CPE.
Okay.
I'm hoping everybody sees that.
So there we go. All right, so now I'm seeing it. So the steps for CPE, it's important, I know, to a lot of you that you get, whether we get the CPE for this session. We use a thing called Conferences IO. You can see the little button on the side of the screen, on the right side of the screen, and it's at the top. There's a button that looks just like that called Conferences IO. Click on that, you register with your name and address or email address, and then the polling questions as we go through the session will show up in the Conferences IO window. If you navigate away from Conferences IO during the session to use the chat to put a question in for our speaker, you can navigate back to that window at any time as the poll questions come up. Please keep in mind that you have to answer the poll questions if you want to get your CPE credit for this session. It's fairly simple once you get in there. If you cannot get in there for some reason, there is another way to check in through the bonadio.cnf.io, which is also going to get you into the session for CPE purposes, and you can do the questions through your phone. So, and in the chat, there's a QR code that was just sent out to do that as well. So there's a bunch of ways you can get in there. If you're having trouble getting into Conferences IO, please put something in the chat, and our tech people will help get you set up in there. Couple other administrative things. I know we're eager to get into the content. We're almost there. Presentation materials. We often get questions about the presentation materials. Those will be sent to you within 2 weeks after the session. So you do not have to, take screenshots and things of the materials. They'll be sent to you. And also, we have a bunch of more sessions. This is our first session. We have a bunch more sessions over the next few days. Please go to our website as instructed here. The annual Financial Institutions Professional Webinar Series at bonadio.com. And look at the other sessions if you haven't seen them already over the next few days for more educational materials as well as more CPE opportunities this week. So without further ado, allow me to introduce our first speaker. Our session today, again, is Economic Update, Surging Debt and Falling Inflation. We have Dimitri here with us. We're very pleased to continue our partnership with Piper Sandler related to this session on an annual basis. And we're excited to hear what Dimitri has to talk about related to the economic update. Dimitri is a senior econometric and macro strategist with Piper Sandler, and they have a dedicated team who works specifically with financial institutions on this type of stuff. And I'm sure this is going to be very informative. As he's going through things, if you have questions, please use the chat feature in the software. We're monitoring that continuously. And without further ado, I'll turn it over to Dimitri.
Well, thank you, Jeff. Hopefully everybody can see my screen right now. It says 2025 U.S. inflation interest rate outlook. We're good? Excellent. Okay. So things we're going to talk about, obviously, is going to be inflation, what the Fed is doing. We're going to talk about debt, deficits. Do we expect them to lead to higher interest rates? We'll try to gauge the next recession, consumer overspending, and the last thing would be on loan growth. So let's start with inflation. Now, obviously, this is one of my more telling slides. Basically, it shows you CPI inflation. It comes out every month. Tomorrow, we're going to get the next print for November. And basically, what you see here, you see headline CPI broken in its 5 main categories. You have services, you have rent, you have core goods, you have food and energy. And when you look at the slide, you can see what happened during COVID. Each one of these 5 categories exploded systematically. But however, since COVID, since it peaked around 10% headline inflation, notice that all 5 of these categories pretty much have been contracting. If you look at, for example, that red area in the yellow, which is energy and goods, right now they are in negative territory, which means they're not facing disinflation. They're outright deflationary. And if you look at food, which is that blue area, that's been coming down as well. That's facing a lot of disinflationary pressures. The only area really that remains pretty wide here when I look at it, it's rent, shelter costs. So if we can determine where shelter costs are going to be headed over the next 6 to 12 months, then we know where inflation is going to be headed. So let's look at that green stuff in a little bit more detail. Now, the green stuff, what is it comprised of? It's comprised of 2 things. It's comprised of owner's equivalent rent, and it's comprised of primary residence rent. What's primary residence rent? It's what people pay when they rent an apartment out there. And owner's equivalent rent is a value that is calculated by the by the Bureau of Labor Statistics. And the way they do it is they go out and they ask people that already own homes, where would they rent their homes at what value? So those are the two components that comprise shelter costs. And you can see that they peaked during COVID. They've been coming down now. But what's more important is that orange line that you see on your screens right now. That's new tenant rent index. And here's the difference between the two lines that I mentioned before and the orange line that I mentioned now. The new tenant rent index contains information only from the last month. So it's current information of where rents are. The other two lines, the blue and the black, they have information from 12 months ago, 6 months ago. So they really have information that is on a lagging basis. And this is important because if you want to assess where inflation is going to be headed, you need to look at that orange line. Now, remember, the Fed uses the blue and the black line. There's a 9-month lag because it takes about 9 months to see here for me to line up the peaks and the troughs. So by looking at what happened to the orange line, which is a leading indicator, it is telling you, and you know automatically where that blue and black line are headed, where they're going to be headed over the next 6 to 9 months. They're going to be headed lower. I mean, they cannot, but because of the way it's designed. It's a lagging indicator. It tracks something that has already happened. So mathematically, reflexively, those two lines are locked in to move lower over the 6 to 9 months. They just can't break away from that. So what you should be expecting shelter costs to move lower over the last 6 to 9 months. Is the road bumpy down? Yeah, it can be bumpy. But what you should be looking at long term. And what this slide is telling you is inflation is moving lower. But besides the micro perspective, from the macro perspective, inflation is also locked in to move lower. And the reason I'm saying that is because what really triggered inflation to begin with? It was supply disruptions. And but what are supply chains doing now? Supply chains are back to normal. When you look at the slide currently on your screens, there's two figures. The figure to the left is domestic. The figure to the right is international. Both of them are calculated are determined by the Federal Reserve. And you can see on the left side, basically what the Fed does, they conduct a survey. They ask various companies in the Philadelphia, New York area, Kansas City, Dallas, what's happening with their delivery times for various manufacturing companies. And you can see when they were asking that question back in 2021, 22, that black line was all the way up to 40, which means 40% more companies back then were saying things were getting worse. Now, when they ask that question, you can see where it is. It's back. It's balanced. It's back to zero, which means things on the supply side domestically are back to normal. And the same thing applies when they ask these types of questions to companies outside the U.S. So they conduct a survey also where they ask companies in the 8 largest countries in the world, like the UK, China, Japan, South Korea, the EU. And when they ask that question, you can see where supply chain pressures were during COVID and where they are now. They are back to normal. So the supply side that triggered inflation is back to normal. So what we're left with now is the demand side. Remember, you need supply and demand to have inflation. And on the demand side, I can tell you, again, as I did with the shelter cost, that inflation is moving steadily lower. Now, one way to view that is to look at the money supply. Remember, Milton Friedman said inflation is always and everywhere a monetary phenomenon. And that's exactly what happened when the Federal Reserve doubled its balance sheet and when the federal government introduced 3 rounds of fiscal stimulus packages. Together, between the Federal Reserve expanding its balance sheet and the fiscal stimulus packages from the government, I think that amounted about $10 to $12 trillion hitting the U.S. financial system in a very short period of time. And of course, it created inflation because look at the money supply. The money supply, which is that black line, that was expanding since we have data for this series, has been expanding since 1959 at a pace of about 6 to 7%. And when COVID hit, you can see, and when the supply, all that money hit the system, it jumped all the way to 28%. And of course, when you have such a big jump in the money supply, of course, it's going to push inflation higher. And it did. And you can see headline CPI is tracked it all the way up, and now it's tracking it back all the way down. But again, if you get anything from this presentation today is inflation is a lagging indicator because, again, I had to lag inflation, in this case, by about 16 months here, you can see, in order to match that peak. Now, with money supply having dropped and leading inflation, where should inflation be headed over the next 6 to 9 months in 2025? It's going to be headed lower. The road is going to be bumpy. Nothing is ever really linear downwards. But don't ask where inflation is going to be next month. You should ask where inflation is going to be 9 months from now. And this chart tells you that inflation is going to be significantly lower from where it is today. Now, granted, you may be looking at that line, M2 supply. You can see it crossing back up above zero. But remember, that's, in my view, that's still disinflationary. Why? Because between 1959 and until 2021, until we had all that money hit the system, money supply was growing at a pace of about 6 to 7%. I mean, that's a normal pace of growth in the U.S. economy. I mean, our economy is growing. There's more people coming into the economy, more business. Therefore, you need more money in order to accommodate that growth. So that's a normal growth rate, about 6 to 7%. And right now, it's close to about 2%, which means there's a lot more way before growth in money supply would be inflationary. But going forward, the takeaway from here is inflation is headed lower. But one of the more important aspects of this presentation and why inflation is headed lower has to do with the fact, and I'm going to show you in the next slide, it wasn't the Fed that created this demand that pushed inflation higher. What it was the fiscal policy. It wasn't monetary policy. It was fiscal policy, purely fiscal policy. And the reason to show you that is with this chart, based 2 lines again. The black line is the cumulative excess personal savings. This is all the money that hit the system due to COVID. This is the money that people got in their hands. Remember, the government gave 3 rounds of stimulus packages. Even if you hadn't lost your job, you got and you made it all the way up to $150,000 a year, you got the full amount. If you were a retiree, you didn't get impacted by COVID, you still got the full amount. 3 rounds of stimulus packages. So once that money started hitting the system, you can see inflation started moving higher as well. When the money peaked, so did inflation. When the money started going away because people started spending it, they had less to spend going forward, you can see that core PCE, which by the way is the Fed's preferred measure, started moving lower as well. Now, the important thing here is that the cumulative excess personal savings have been depleted. So what is core PCE going to do? It's just going to go down. And again, I mentioned in the 2-3 slides before, there's a lagging component here. In order to match the peak here, we had to lag it by about 10 months. So where core PCE is headed forward. It's going to track that black line. And that black line has dropped all the way down to 0 right now. So over the next 6 to 9 months, I expect inflation will continue to drift lower as it mathematically, reflexively, it's an autopilot to track this line down. And why is it going to happen this way? Because it's a lagging indicator. This is what the Fed uses. They use a lagging indicator. If they use a forward-looking indicator, I wouldn't be able to say this to you. But because they're using something that's lagged and it tracks something that has already happened, it's destined to move lower. So inflation should move lower, and you can see that it has been coming down, and I do expect that over the next 6 months, the inflation that we see in core CPI and PCE will be closer to that 2% level, which is what the Fed wants. Now, with that, what is the Fed going to do going forward? And of course, you do know what the Fed is going to do. They already have done it. They have lowered rates by 75 basis points, and they will continue to do so. This is what the Fed fund futures are pricing in. Basically, this is probably a week or a week and a half old, this slide, but I looked at the most recent today. Probabilities. Basically, what this slide shows you, it shows you how many rate hikes the markets are pricing in. The horizontal axis at the top, what it shows you the Fed meeting. So we have the upcoming December meeting, which is going to be next week. And right now, what the markets are pricing, they're pricing with I believe, an 85 to 90% chance that the Fed is going to hike again. And if you go all the way at the end where December is, December 2025, the markets are pricing an additional 3 rate cuts by December. In my view, I think most likely the Fed is going to hike more than just 3 rate cuts in 2025. But this is a very volatile number, and they do change with what CPI may be tomorrow, and they're going to change again with what the non-farm payrolls we get in January are going to be. But for now, this is what the markets are pricing. The markets are still saying the Fed is going to cut rates. And if the Fed cuts the rates, whether they cut 3 times or 6 times in 2025, what should you be expecting for the curve to do? Well, the curve is going to come down. And the way to show you that is to show you what the curve has done in the last 7 easing cycles. And this is data on the charts that you see right now that has the 2-year, the 10-year, and the Fed funds rate back to 1980. Those red dashed lines there, those are visual aids to show you where the Fed cut rates for the first time. So you can see when the Fed cuts rates for the first time, what happens afterwards? Both the 2-year and the 10-year continue to move down. And that's exactly what I expected to happen in 2025. As the Fed continues to cut rates, you should see the 2-year and the 10-year to move lower. So rates should follow the same path they've been following for the last 50 years. When the Fed starts an easing cycle, they will just move lower. But besides rates moving lower, what's going to happen to the curve? So here's a question. It also happens to be a poll question. How does the Fed easing cycle affect the shape of the yield curve? So I don't know, somebody here, science should.
Everyone should see the poll question in your conferences IO on the side of the screen. Please answer the question and you'll be registered in to get your CPE credit.
Will we see that? Are we going to see the results as well?
No, Dimitri, you won't. You can continue on with your presentation.
Oh, I should continue on.
The participants can respond.
Okay, so for those who answered the question and they said what happens, I can tell you what the answer is. The answer is a bull steepener. And we know this because we have the answer on the next slide. Here it is. This is what happens when the Fed starts easing. The blue line is the difference between the 10-year and the 2-year. The black line is the Fed funds rate. The red lines are there drawn as visual aids to show you where the Fed cuts rates for the very first time. And you can see that blue line spikes up. You can see it steepens. The curve between the 2 and the 10-year steepens. And that's what the blue flattener is. Now, what I expected to happen going forward is the same thing. There's no reason why it would change. And it's going to steepen because as the Fed starts cutting rates, the short end, which is closer to the Fed funds rate, is going to drop a lot more than the long end of the curve. And you will get your bull steepener that way. Now, one of the questions that, always pops up is, okay, well, the Fed is going to start cutting rates. How much is the Fed going to cut rates? And I showed you initially what the market is pricing in right now. It's pricing 3 more rate cuts in 2025. I can tell you, if you go back 2 months, it was pricing 6 and 7 rate cuts. But anyway, the question now is, how much do we think the Fed is going to cut rates? One way to answer this question, which in a way it's objective, is to look at historical data. So what I've done in this slide, basically I plotted the difference between the 10-year and the Fed funds rate. And the reason I did that is because I have found there's a strong correlation by how much the curve inverts and by how much the Fed eases in each cycle. So here you can see that under Arthur Burns, the curve inverted by 554 basis points, under Paul Volcker by 775 basis points. Then, of course, you have Greenspan, you have Yellen, Bernanke, Powell, etc. But these are the maximum inversions that we had during each one of those cycles. Now, the maximum inversion that we had as of late is that negative 182 basis points under Powell. That's the maximum inversion. So what I've done in the next slide, I've taken all these maximum inversions and I plotted them against the total amount of easing that has taken place. And this is what it looks like. The x-axis is the maximum inversion. The y-axis is total Fed easing. They pretty much fall in a line. The R-square is about 89%. So with one variable, we are explaining 90% of the move that has taken place. I would say that's pretty good for a statistical model. So how are we going to use this information now? Well, I said, and I showed you in the earlier slide, that the maximum inversion that we had right now is 182 basis points. So focus a little bit less than the minus 200 basis points right there on the x-axis. And then from there, project a line up to see where you intersect the sloping line. And from the sloping line, then project across to the y-axis to get the other coordinate there. What you're going to see is it falls to about 550 basis points, which means for the maximum inversion that we had of 182 basis points, what the Fed should do, if they follow just the average historical rate easing that they've done, they're going to cut rates by about 550 basis points, which means they're going to bring rates back down to zero. And again, what I'm showing to you, I'm showing you historically, if they follow the average easing of monetary policy that they've done over the last 50 years, this is the average, they should bring rates back down to zero. Now, of course, they may not cut by 550. Maybe they cut by 400 basis points. Or on the flip side, maybe they cut by 600 basis points and they turn negative and we get negative rates. But that's what the average monetary policy on a historical basis is telling us. Now, of course, by saying rates are going to go back to zero, some of you may say, well, how can they do that? Have you seen the amount of debt that we have? And true, we have a huge amount of debt out there that puts the U.S. in a very difficult position. And which takes us to the next slide. How large is the U.S. federal debt as a percentage of GDP? Is it 123, 97, 75%, or 55%?
Let me just add for all the participants, you do not have to get the correct answer to the question. You simply have to answer the question to get your CPE credits.
So I can tell you the correct answer. I mean, because I put it in the parentheses there, marketable debt, it's about 97%. If I had total federal debt, which means the money that was in the Social Security system, and obviously Congress took it out to spend it, and they have IOUs in there, then the debt is a lot greater, and it's 123. But the right answer for this one is 97 because we're talking about marketable debt. But either way, that's a huge amount of debt the U.S. has right now. And you can see that on this slide. You can see U.S. debt to GDP has grown from about 40% in the mid-2000s all the way up to 100%. This definitely puts the U.S. in a very difficult position. We could say it puts the U.S. on a fiscally unsustainable path. And you can see that clearly here because look at the amount of interest the U.S. is paying right now. Interest payment on U.S. Treasury public debt. It's close to over a trillion. It's more than what the U.S. spends on military. And as a percentage of GDP, it keeps on moving higher. And the higher it goes, it puts the U.S. on a less fiscally sustainable path. With that, it makes sense for rates to move higher. I mean, definitely. I mean, the more debt a country accumulates, investors are going to require a risk premium for lending to that country money going further out the rate curve, further out the curve. However, the one thing that I want to say here, that is not true for all countries. That is not true for all countries. It might be true for emerging market countries, maybe true for Brazil and Mexico and Argentina, but it is not true for countries like the US or Japan. And this is not because me saying this, is because that's what the empirical data says. From a theoretical perspective, definitely you're right. The US should be paying higher rates, but look at the empirical data. It shows you debt and the 10-year treasury rate. It shows Japan debt and Japan's 10-year rate. What do you see? You see debt has been increasing and rates have been going lower. And look at Japan's. They went from 50% to 250%, and their rates are about 1%. The 10 years about 1%. So the empirical data doesn't support the view that rates for these countries have to move higher. So if the size of the debt does not push rates higher, what is it that the markets do care about? And I can tell you what markets care about. For for these larger countries, for now, and I gotta emphasize this for now, because at some point that's going to change too. But for now, what they care about is not the size that Japan's debt or the size of the U.S.'s debt. What they care is, can you guys pay me back on the interest that you are responsible for? So they care, can the U.S. pay me back? If I lend you money out 15, 20, 30 years, are you going to pay me back in a timely manner? And one way to show you that, and I done that in the next slide, is, well, on this slide, for example, that I showed you, I took the amount of debt the U.S. has here, this black line, and I multiplied it by the Fed funds rate. And when I do that, when I multiply debt by Fed funds rate, what do I get? I get a rough approximation of the interest that the U.S. is responsible for paying. So I done that on the next slide, and notice how well it tracks the 10-year Treasury rate. The black line is debt to GDP times the Fed funds rate. The orange line is a 10-year Treasury rate. They fall pretty much right on top of each other. So what markets care, if they're going to lend the U.S. money out for 30 years, can the U.S. pay me back? That's what it cares for now. Now, you can see that between 1962 to 2021, how well they tracked each other. Now, the chart to the right, I added the last 2 years. And this is important because the last 2 years, you can see the amount of interest that the U.S. is responsible for has skyrocketed. And the longer it stays at these levels, the more pressure it's going to put for the 10-year Treasury to move higher. And that's why the 10-year Treasury did move higher. And then we saw it subsiding in November of 2023 when the Fed came out and they said they're going to start cutting rates. And when the Treasury shifted issuance from the long end of the curve to the front end of the curve, those two things help. And with the Fed cutting rates, that obviously has helped manage the problem that the U.S. currently has. But going forward, in order for rates not to move higher, what can the U.S. do? And I can tell you what solutions exist out there, and I'll tell you what is the most likely solution for the U.S. Because I don't think anybody in the U.S. government or in the Federal Reserve want to see the 10-year move go up to 5 or 6 or 7%. Because when I look at this chart to the right, that's exactly what it's telling me. I mean, based with historicals, the 10-year Treasury should be trading a lot higher given the amount of debt the U.S. has. So how can the U.S. manage this so this does not happen? And I can tell you here are some of the ways that I've seen that the U.S. can manage the problem. Well, the U.S. can default, but you know that's not going to happen. Well, the U.S. can inflate its way out of it, but again, the reason the Fed has raised rates is because we don't like inflation. Now, economic growth is probably one of the best ways to do this because this is how the U.S. got out of the huge amount of debt that it had after World War II. But when nominal GDP is growing at a pace of about 6%, and deficits are also growing at a pace of about 6%, you're not going anywhere. Now, you could raise taxes and cut spending, but you know better than me, there's about 535 people that are not going to let that happen. Their jobs are more precious than raising taxes or cutting spending. So that's not happening. So what is the best way to put the U.S. back on a fiscally sustainable path? Obviously, they're going to have to lower rates. And the Fed at some point is going to have to lower rates back to zero. And one of the reasons is, think about it like this. The U.S. has $6 trillion in T-bills. And it's paying, let's say, about 5% on those. That's $300 billion. What if they were to lower rates to zero? They're going to pay zero. They knock off from that interest component that I showed you earlier that the U.S. pays close to about $1 trillion. Just overnight, if they were to lower rates to zero, they're going to knock off $300 billion. So the question is, why wouldn't they do it? And of course, they're going to do it. And I think that I'm not saying this is the best solution or it's a long-term solution, but nobody likes pain. They like kicking the can down the road. And to me, this seems the most obvious solution going forward. And of course, in order to do that, they would need some cover. I mean, they do need inflation to keep on coming down. If inflation moves in the other direction, they're going to have difficulty doing that. But as long as inflation keeps on moving down and it hits that 2% level, I think they will have all the cover they need to lower rates to those levels. On top of that, what if we do get a recession? That's the other thing. Now, I know a lot of people out there, a lot of people are talking that, a soft landing is more likely. But when I look at 60 years worth of data out there, I don't see the soft landing theory to be the more prominent, to be the stronger one. I see the recession case being a lot more stronger than the soft landing. And to show you, to illustrate this, I want to show you what a soft landing looks like and what a recession looks like. And you should make your own decision in which camp you are. Here, for example, is the leading index. This has 10 leading components in there, like building permits, like new orders, for example. I mean, you need a new order before a company produces something. It needs a building permit before it breaks ground. So it has 10 components like that are leading. And when you look at this chart, you can see that it has never been this low over the last 50, 60 years without getting a recession. Those yellow shaded periods, those are recessions. When it drops to these low levels, 100% of the time, we got a recession. Look at the blue areas. Those are soft landings. That index didn't drop to these low negative levels. It stayed close to zero or remained positive. So that's what a recession looks like. That's what a soft landing looks like. But wait, there's more. I mean, look at this one. This is the 3-month, 10-year Treasury. This is the steepness of the curve. Again, we have 60 years worth of data. Whenever the curve turns negative, like it has now, what do you get? You get a recession. And you got a recession every time that curve has turned negative. Now, we have 2 soft landing episodes. And you can see what they're looking at, look like. Did the curve turn negative during those soft landing episodes, which I have designated in blue? No. So that's the difference between a recession and a soft landing. But wait, there's more. Let's look at this one. And I can keep on going on. There's a lot more, but here's one more on the employment front. The small business indicator pointing towards a recession. Usually in the past, when this indicator has been dropping, like it has now, we get a recession. During soft landing periods, kind of remains flat or goes higher. That's not the case. Again, that's the difference between a soft landing and a recession. Now, one of the questions you might ask, and it's a very legitimate question, is, well, where is the recession? Why haven't we got a recession yet? Well, I think that based on historicals, the window for recession has not passed, and it's on target to happen. But before, let me see. Here's a polling question, I guess. What have delinquency rates for credit cards been doing over the past 2 years? Well, this polling questions should be a little bit further in the back, and we're going to get to that. But basically, they have been increasing. But the point that I wanted to make, and I was going with my slide is, I was saying that the recession is right on target to happen again, and it's not out of line. And here's why. Look at this slide because it's very important. It tells you when a recession happens in the U.S. All you have to do is just by observation, look at it. This is the Fed funds rate. Those yellow shaded periods are recessions. When does a recession happen? Does it happen when the Fed starts hiking rates? Does it happen when the Fed goes on a hold, pauses? Or does it happen when the Fed starts cutting rates? And you can clearly see when the recession happens. It happens always, 100% of the time, when the Fed starts cutting rates or is in the process of cutting rates. It happens 1 to 2 quarters on average after the Fed starts cutting rates. The Fed started cutting rates in September. So if we look at historicals, what this says, it should happen sometime in the first quarter of 2025. And again, remember, this is an average. It doesn't have to happen the first quarter. It could happen the second, maybe if it's longer, the third quarter. But basically, this is what it's telling you. It's telling you that recessions always happen after the Fed starts cutting rates. Now, it may seem counterintuitive. Why does it happen when the Fed starts cutting rates? My simple explanation for this, to make it more intuitive why it happens, is think about the U.S. economy as being a big truck. And every time they hike rates, the truck accelerates. Now, at some point in time, this truck that's accelerating very fast is going to see a wall. This wall is the recession. So what do they need to do to stop this truck from falling to the wall, from the economy hitting the recession? They need to apply the brakes. They need to start cutting rates. Well, the thing is, if they start applying brakes in time, they will avoid the crash. If they apply the brakes late, the momentum, and in this case, when I say momentum, I'm referring to the lag effect from the interest rates that have interest rate hikes or interest rate cuts or whatever, whichever way you want to look at it, from the lag, because interest rates work with a lagging component, they have a lag effect. So if that momentum is still intact, they will hit the wall. Now, remember I showed you that the last two times there were two soft landing periods. When you look at those two soft landing periods, you can see that their gauges, which leading economic indicators, the jobs that they were adding for small businesses, the inverted curve, those were showing different signals than when we had a recession. And right now, when I look at the gauges of my truck here, I see the same type of gauges or what I've seen in the past when we always hit a recession. That's why I think the window for a recession has not passed, and it still remains strong. And I think it's still stronger than what it is for a soft landing. Now, some of you may say, okay, well, have you seen the job market? It still remains healthy. But I can tell you this about the job market, which takes me to the next polling question. What kind of economic indicator is unemployment in the labor market in relation to the direction of the economy? Is it a leading, a coincident, a lagging, or no correlation? Well, I can tell you it is a lagging indicator. And here's the answer. Here you can see it right yourselves on this chart. It shows you the periods of recessions, and it shows you the unemployment rate. And when does it spike up? When we are already in a recession, not before. Before that, it's in a bottoming out process, just as it is right now. And then when we hit a recession, it just spikes up. So if we do go into recession in the first quarter, that's when you should be expecting the unemployment rate to move higher because it's a lagging indicator. Now, what could cause a recession as well? Well, I think, obviously you could have some kind of financial crisis related, commercial real estate or something. But one of the components that I see also that's very vulnerable and could cause it is, consumer spending. You can have consumer spending slowing down. And the reason I'm saying that is because consumers have been spending more than they have been earning over the last 4 years. The chart on your screens right now shows you consumer spending. It shows you the difference between income and spending. When it's green like this, it means Americans are earning more than they're spending. And when it's red, it means that they are spending more than they are earning. Now, between 1995 and 2019, average spending was 4.6 and average income was 4.6. That makes sense. You make what you spend, or you spend what you make. But the last 4 years, you can see they've been spending a lot more than they have been making. 6.9 has been spending. The average income was 6.4. Something like this is unsustainable. It's unsustainable. And how have U.S. consumers been doing this? Well, you can see this chart gives you the answer. Credit card debt has risen to new historic highs, and of course, they're saving a lot less as well. Credit card debt has increased to 1.35 trillion. This black line is reflected on the left-hand side axis. And of course, when you have so much debt and the Fed has raised rates to historically high levels, you're going to be paying a lot more interest on your credit cards. Right now, credit cards, the last that I saw, I think it came out last week or 2 weeks ago, it showed credit cards being average credit card rate being at a 22.7%. I think that's a historical high level. When you have credit card rates at these high levels and you have also all this debt out there, what's going to happen? Interest is going to move sharply higher. Here's total interest on credit card payments. And I've overlaid it with a total revolving consumer credit card debt. Again, total revolving consumer credit card debt is on the left side. The interest on credit card payments is on the right side. Notice the big jump. Why? Because the Fed raised rates and credit card rates jumped sharply higher. So right now, what Americans are paying, you can see here, and you can read it off the left axis, they're paying close to about 300 billion in interest card payments. What were they paying before COVID back in 2020, 2019? You can see it. They were paying about 150. It was half of what they're paying now. Now, I don't think their wages have doubled during this time. So obviously, this is putting them in a very, very difficult position. And of course, if in a difficult position, they probably cannot make all these payments when they're so high. And how can we see that? Well, the best way is to look at the delinquency rates, which comes back to the poll number 3 question that was asked. Should have been, I think we should have placed it right here, which shows what has happened to credit card and auto spending. Delinquency rates. They've been moving sharply higher. Okay, on the slides here, you can see from 2000, you can see the blue line is the auto delinquency rate. The black line is the credit card delinquency rate. Notice they're back to 2010 level highs. They're back to the highest level for more than 13 years. That's how high they are. But what's interesting about this slide, and for me, which I find more worrisome, is look at the delinquency rates during recessions. That's when delinquency rates go higher. You see it in 2000. You can see it in 2008 when we had a recession. We had a slowdown. People started losing their jobs because of the recession. That's when they cannot make the payments. That's when you should be expecting delinquency rates to go higher. Right now, we looked at the labor market and we see unemployment rates still being low. And we talked about it. So why are delinquency rates moving higher? Imagine what's going to happen if we do hit a recession. Where are these delinquency rates going to go? They're going to go sharply higher than where they are right now. This is going to put pressure on the system, on the financial system, on the U.S. economy. Now, in my view, one of the major components of why the U.S. Consumer has been held up so well, part of it has to do, obviously, they've been borrowing more. 2, they took all that COVID money. They were able to spend their money, obviously, alleviating financial pressures, but that money is gone. Student loans were postponed, payments were postponed, but that's over as well. But I think more importantly, it has to do with a wealth effect. Here's the S&P, here's the Case-Shiller National Home Price Index. Both of them are at historically high levels. And obviously, and I'm saying this, the wealth effect, for example, is very important. We've seen equity portfolios or equities over the last 2 years go up by 20%. So when consumers open up their 401k statements, their IRAs, and they see that they have this kind of money, obviously they're going to be more happy about spending. They're going to feel more comfortable about the future. And you can see that. You can see here the connection between consumer spending and the wealth effect. The orange line is the black line is the wealth effect. You know, when your equity and your home prices go up on a year-over-year basis. And notice how well consumer spending tracks that with a 3-month lag. Now, the question is, and I'm not saying, remember, for the last 2 years, equities have moved up by 20% each year. Americans have been feeling more comfortable because of that. Now, I'm not saying that you need a big correction, but what if in 2025 you get a minor correction, a 5 to 10%? Will consumers be willing to spend as much as they have in the past? Probably not. And I think we are headed in that direction. And here's one slide that will be pointing in that direction. Right now, there is a complete disconnect between equities and economic data. This is a chart that shows you the S&P index and the Citi Economic Surprise Index. Notice how well they've correlated in the past, and now there's a big gap between them. And again, I'm not expecting that the equity market needs to crash in order for the consumer to slow down in spending. A 5% correction. When you're used to 20% returns year after year, and all of a sudden you're not getting that, you're not going to spend as much. So, and remember, it's always about changes when you're calculating GDP growth. And if that spending is not there, you're not going to get that growth. Now, the other thing that could hinder growth is probably if you have slower loan growth. And financial institutions may face that uncertainty about lending, and some of the reasons why they would be in that position. When you look at credit card delinquencies, for example, I did show credit card delinquency rates for credit cards and autos. We show they're rising here. From the bank's perspective, the 100 largest banks by asset size, that's the orange line, you can see they're increasing. For the banks that are not in the 100 largest banks, they are at record highs. So obviously smaller banks are not in the business of doing credit cards. So this is kind of skewed by the 20 largest banks that are in that smaller group, and that not in the 100 largest banks. But nevertheless, the point here is the delinquency rate, with delinquency rates moving higher, then makes a bank's position more uncertain. But besides that, banks have significant unrealized losses as well. If you look at their available for sale securities and held to maturity securities portfolios, they're underwater by close to about $500 billion. Again, this is another reason why banks would be hesitant to lend. But moving away from the portfolio, if we look at the loan side, for example, their financial institutions, there is still some risk for some. I'm not saying for all financial institutions, but there are problems still in the commercial real estate market, especially that collateral that's backed by offices. And here I'm showing you who holds most of the commercial real estate loan holdings. It's pretty much banks between 10 billion to 250 billion in size. And the way you would read this chart is if you look, for example, I bucketed it by different categories. If you look all the way to the left and up there to the upper left corner, banks that have asset sizes less than 100 million, they hold zero CRE loans, and more than 80% of their deposits have FDIC insurance. At the other end of the spectrum, you can see who's there. Those are banks 10 billion to 250 billion. A lot of the banks that we saw in 2023 and 24 failed, like Silicon Valley Bank, First Republic, are coming out of this bucket. And the reason I'm pointing this out is because there's still a looming wall of maturing loans out there, commercial real estate here, over the next few years. And with rates still relatively high, and when they reset at a much higher level, that's going to put the holders of these loans in a very difficult position. For now, they've been playing the game of extend and pretend. We are pretending that the collateral value hasn't dropped for those properties that are backed by office, and we're extending the maturities. But again, once these things start resetting, that's going to be a problem. And obviously, this is an additional uncertainty for banks that makes it more hesitant to lend. And in my view, lending is the lifeblood of the economy. Without lending, you're not going to grow. And here's the chart that shows that there is a strong correlation between bank lending growth and GDP. And you can see that here. You can see the black line is GDP. The orange line is bank lending growth. There's a 12-month lead or lag between the two. So when there's lending, GDP grows. Now you can see where lending is. It has dropped. And when I look at this, it's only a matter of time before GDP follows that orange line down. And again, one of the reasons that has kept spending and growth at these levels, in my view, has to do a lot with that COVID money that pretty much everybody got. But as I showed you, that money is gone. It was gone in November of this month. That's when it hits the zero line. And I do believe going forward, you are going to have a much weaker consumer out there, and especially if equities cannot post those 20% returns again in 2025. With that, I will stop here, and I don't know if there's any questions out there. Feel free to type them in there, or are there questions already?
Dimitri, can I pose one question that's come through?
Yeah.
There's been talk related to our new federal administration that's coming in January, related to some policy discussion about things like tariffs and things that might be inflationary. Can you comment on what that might mean, if anything?
Yes, I mean, you read a lot of headlines and all these experts are saying that we're going to get inflation. Well, they said the same thing back in 2018. And if you look back in 2018, we did not get inflation. In my view, tariffs are disinflationary. I mean, think about it like this. Let's say, I mean, everybody buys a certain item that comes from China, some type of meat. And all of a sudden, we love that meat, but all of a sudden, tariffs go on there. We can't buy it anymore. Fine, the price for that meat is going to go up. I'm going to substitute it with something else. So my basket is going to shift and I'm going to buy something else out there. If they keep, remember what causes inflation. And I think this is my assessment of what causes inflation is money. You print too much money, you give money to people to spend it, they chase few goods out there, that creates inflation. We saw it during COVID. What tariffs can do, it's like a tax. They can trigger inflation, but they're not going to sustain it. In order to sustain inflation, you need money. If all prices went up in our economy and every item out there, and people don't have money to spend on it, prices are going to come back down. You need money. So if President Trump does put tariffs out there, you might see an initial spike in some of these areas. But you know, me as a consumer, I'm going to shift my purchases to something else. My basket every month that comes to my house is going to be completely different because I only have so much money. Think about it like this. What if oil prices went up? That could be, it's not a tariff, but let's say something happens in the Middle East and oil prices spike. And instead of paying $3 a gallon, you pay $8 a gallon. That's like a tariff, right? All of a sudden, you're going to have less money to spend on everything else. Yes, prices for gas are up, but now you're going to spend less for meat, for milk, for everything else. And prices in those areas are going to drop as well.
Thank you for that. Does anyone else have any other questions? Put it in the chat. Seeing none, if you do have questions after the session's over or something pops into your head, please feel free to reach out. We can route those questions through and get back to you on anything that you want to ask about. Thank you very much for joining us, everyone. We really appreciate your time. And thank you, Dimitri. That was very thought-provoking. I really enjoyed it, and I know that our listeners got a lot.
Thank you for having me. Absolutely.
Again, as a reminder, you're all going to get the materials emailed to you within the next couple of weeks. And please check out the website for the other sessions. We have a lot more sessions coming up as we go through the week. Thank you all very much.